Welcome to Value Vest Daily. Today, we're doing a complete reverse engineering of NuScale power, literally from the physics up, to see what a 10-bagger actually requires in the real world. We were recently asked a very specific question: find a small-cap stock that could potentially 10-bag. So we sat down, we did the arithmetic, properly, starting with the physical engineering and working our way all the way up to the financials. And, well, we got an answer that almost nobody is publishing. This cinematic explainer is designed to give you the absolute, unvarnished truth about what it actually takes for a frontier technology stock to generate life-changing returns.
Look, the defining paradox of this stock is just wild. For NuScale to 10-bag, they alone have to deliver roughly 270 modules a year by 2036. Meanwhile, the entire planet only connected 7 reactors last year. Let that sink in for a second. Not 700, 7. Across the immense industrial bases of China, France, India, the UAE, and the US combined, the whole world managed to connect just 7 reactors to the grid, totaling about 7.3 gigawatts of power. So the fundamental question of this explainer isn't, hey, is nuclear the future? The real question is, when a stock is pitched as a 10-bagger candidate, what heavy industrial reality actually has to happen to justify that price? Because looking at the hard physical delivery, that's really the only honest way to price a company like this.
Now, we really have to ground our valuation in reality right now because the company just booked a mere $75,000 in Q2 revenue, all while filing to raise $750 million in stock. That's a massive 10,000x disparity. Okay, let's dive into this. On August 5th, NuScale reported Q2 revenue of just $75,000. A year earlier, that exact same quarter did $8.1 million. That's a 99.1% drop. Yes, engineering study work is incredibly lumpy, and their Romanian project wrapped up its front-end phase, which caused that gap. But just 6 days later, they filed to sell $750 million in new stock. Divide the raise by the quarter's revenue, and you hit exactly 10,000 times. That is a staggering financial reality for a stock that's down almost 85% from its 52-week high. And honestly, it perfectly sets the stage for our analysis today.
So here's our roadmap for this explainer. First, the physics of going small. Second, the balance sheet dilution. Third, a reverse DCF valuation. Fourth, the exact bull and bear cases. And finally, your verdict checklist. Let's get into it.
Part 1. The physics of going small. We need to understand why small is actually a strict consequence of physics, not just a slick marketing decision. To understand why the financials look the way they do, we first have to understand the physical machine. The term small modular reactor is usually pitched as this brilliant business strategy to leverage factory production, right? But the size of the reactor is actually an unavoidable bill that comes due when you change how the machine cools itself. See, NuScale completely deleted the reactor coolant pumps. In a conventional plant like Vogtle, massive pumps push water violently around the core, drawing up to 24 megawatts of electricity and providing 72 psi of driving pressure. Think of those pumps like a huge industrial fire hose. But they're also a massive vulnerability. If you lose power, you lose circulation and the core overheats. NuScale's brilliant engineering answer was just to delete the pumps entirely. Instead, they use a passive chimney effect. Hot water is less dense than cold water, so it rises up the center, cools, and falls back down the outside. But this natural circulation only generates about 1.6 psi of driving force. And the thermodynamic math behind this reveals a massive constraint. Because you absolutely cannot push very much water with the pressure equivalent of a party balloon, the reactor must remain tall, narrow, and low-powered at exactly 77 megawatts. At their operating pressures and temperatures, the density difference between the hot and cold water, multiplied by gravity and vessel height, gives you that 1.6 psi. It's a gentle stream compared to the fire hose of a conventional pump. Actually, it's roughly 44 times weaker. To move enough coolant to stay safe with only 1.6 psi, the core literally has to be 1/20th the size of a standard reactor. So small isn't a feature they chose in a boardroom, small is the strict thermodynamic bill you pay for deleting the pumps.
But in exchange for sacrificing power output and economies of scale, NuScale gained unparalleled passive safety, earning them a genuinely massive 7-year moat as the only NRC-approved standard design in America. So what do you actually get for paying that thermodynamic bill? You get indefinite core cooling. In an emergency, you don't need pumps, you don't need power, no added water, and absolutely zero operator action. You just walk away and the physics of the design cools itself. The Nuclear Regulatory Commission accepted this claim. This isn't just a marketing brochure, folks. This is a real, immensely valuable, fiercely protected intellectual property moat. But it does come at a cost of thermal efficiency, dropping from around 33% in a big plant to about 30.8% here.
Part 2. Dilution and the red zone. Now we're going to look at the staggering cost of waiting for this tech to materialize.
Let's talk about the actual dollars and cents required to take this beautiful physics experiment and turn it into a commercial power plant, because this is where the investment thesis hits incredible friction. The only NuScale project to ever be fully priced, the now-canceled carbon-free power project, came in at over $20,000 per kilowatt. That makes it 23% more expensive than Vogtle, literally the priciest nuclear plant in American history. The SMR was supposed to be the cheap, predictable answer to conventional delays. So what happened? Well, when NuScale fully estimated their own first-of-a-kind project in 2023, they ran into the exact same macroeconomic buzzsaws that hit Vogtle: engineering delays, supply chain breakdowns, massive labor inflation. Now, to be fair, the whole premise of SMRs is that the 10th unit rolling off a factory assembly line is vastly cheaper than the very first bespoke unit. But in the heavy industrial world, until that factory line actually exists, that cost reduction is just an argument. It's not a demonstrated fact.
And while the market cap looks huge right now, half of the company's valuation is essentially a savings account holding $1.89 billion. This puts the actual enterprise value of the technology at a much more sober $1.88 billion. NuScale ended the second quarter with almost $1.9 billion in total liquidity. If you spread that across roughly 430 million shares outstanding, that's $4.41 of pure cash per share. With the stock trading around $8.76, that means 50.3% of the price you pay is simply buying cash. So the market is basically valuing the underlying technology, that world-class NRC license, and the entire future commercial pipeline at less than $1.9 billion.
We call the gap between today and the 2030s the dilution zone. Why? Because with a $746 million annualized cash burn, every single year of survival is paid for by issuing new stock. NuScale's share count grew almost 29% in just 6 months. That's a 66% annualized dilution rate. They're burning through cash rapidly to finalize engineering and keep their workforce intact, which is exactly why they filed that massive $750 million at-the-market offering, bringing immediate and heavy dilution to new investors. And management fully acknowledges that the first commercial deployment won't actually happen until the early 2030s. That massive multi-year gap before any real cash flows in, that's the dilution zone, and it is absolutely the single most important factor for investors to consider.
Part 3. Reverse DCF Valuation Math. Let's run the numbers backward to find out what reality looks like. Because NuScale has practically zero revenue today, a standard discounted cash flow model is basically just a random number generator. So instead, we work backward. And working backward from a 10-bagger target reveals that by 2036, NuScale would need to generate an astonishing $50 billion in single-year revenue. Okay, here's how that math shakes out. A 10-bagger takes the market cap to $37.64 billion. Strip out the cash on hand, and you get an enterprise value of about $35.75 billion. Now we apply a 12% weighted average cost of capital, or WACC. That 12% is crucial. It reflects the massive risk of funding frontier hardware over an entire decade. Discounting that future enterprise value back 10 years at 12% means the required free cash flow in 2036 is basically $10 billion. If we generously assume a 20% free cash flow margin, which, by the way, is the absolute upper limit standard for heavy industrial equipment manufacturing, that requires a mind-blowing $50 billion in top-line revenue in the year 2036 alone.
And this creates a really counterintuitive paradox for investors. The cheaper the reactors get to build, the more modules NuScale actually has to sell to hit that $50 billion revenue target. Think about it. If a finished power plant lands at $8,000 a kilowatt and NuScale captures about 30% of that total project cost for module supply and services, they earn $2.4 billion per gigawatt. To hit $50 billion in revenue, they need 20.8 gigawatts a year. At exactly 77 megawatts a module, that translates to 270 modules every single year. And just look at the relationship in the data here. If the price comes down to the industry target of $4,500 per kilowatt just to compete with natural gas, they actually need to sell 481 modules a year. So the entire bull case relying on drastic cost reduction, it's mathematically a bear case on the sheer volume of units they must manufacture and deliver.
Plus, because the share count is rapidly expanding at roughly 66% annualized, a 10x return in the stock actually demands an 18.6x return in the fundamental value of the company just to offset the dilution drag. Guys, this is the silent killer of returns in deep tech. A 10-bagger in the stock price is not a 10-bagger in the company's valuation. Every time they issue new stock to fund operations, your slice of the future pie gets smaller. If the share count balloons from 430 million to 800 million by the mid-2030s, which honestly is highly conservative given their current burn rate, the company's intrinsic value has to grow almost 19 times just for your specific shares to go up 10 times. Dilution literally acts like gravity on your portfolio.
Part 4. Bear case versus bull case. Let's break down the expected value and see if it's a buy. If we multiply the low probability of massive scale deployment by the probability of actually surviving the dilution zone, we get roughly a 1.2% chance of a true 10-bagger. That's about double SpaceX's odds at a similar stage, but 1/7 of Rocket Lab's odds using our same framework. And weaving those probabilities into our models yields a truly shocking finding. Our base case of $1.81 is barely above the bear case of $1.44, proving that heavy dilution can convert genuine commercial success into almost zero shareholder return. In our bear case, they burn cash, never scale, sell the IP for scrap, leaving about $1.44 per share. But in our base case, they actually succeed. They build reactors on 2 continents, hit $1.5 billion in steady revenue, and yet the stock is only worth $1.81. Why? Because the massive share dilution required to survive until 2036 eats virtually all the upside. The bull case, where they become the undisputed Western SMR standard with $6 billion in revenue, yields $10.63. Probability weight these scenarios together, and the true expected value is $3.88. Against a current price of $8.76, that is a heavily skewed downside.
And if we look at the technicals, the RSI shows neutral momentum, but the price has critically fallen below its 200-day and 50-day moving averages, meaning all major resistance is now overhead. Our 14-day Wilder RSI reads 46.8, so the stock isn't heavily oversold yet. But breaking below that 200-day simple moving average of $8.80, that's a serious technical warning sign for institutional investors. The last layer of long-term technical support just gave way. Now every major moving average acts as a ceiling or resistance on the stock price. Basically, the market is actively pricing in the mathematical reality of the dilution we just calculated.
Part 5. The verdict and checklist. Here are the 4 brutally honest questions you have to ask yourself.
NuScale is a binary option rather than a steady compounder. Deciding whether to invest requires answering 4 questions. As we love to say, we don't do blind buy or sell calls here. We provide you with the framework so you can critically evaluate the fundamental reality yourself. So here's your checklist. Question 1 is massive. Entrawan holds the exclusive global rights to commercialize this tech, and NuScale paid them $495 million last year. Can Entrawan actually step up and finance 6 gigawatts of nuclear power infrastructure? Question 2. A license is just permission to build, not a purchase order. We need to see binding power purchase agreements. Question 3. You must model and own your specific dilution assumption. And question 4. What happens if this falls another 40% to around $5.25? That is an entirely ordinary, probable outcome here. If that makes you sick, your position sizing is simply too big. You've got to size this so that being wrong is boring.
Remember, this cinematic explainer is an educational tool to help you understand the physics and financials of frontier tech, and is not financial or tax advice. The technology here is incredibly real. The physics of natural circulation are elegant, and the NRC license is a genuine, heavily defended asset. But the pure arithmetic required for a massive return, it's absolutely brutal. Holding all of those conflicting truths in your head at once is exactly what investing in frontier technology feels like.
Please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. And one more thing, please put in a comment if you want us to deep dive into any specific high-risk/reward opportunities. We absolutely love breaking down the complex physics and financials behind these massive global trends, so let us know what you want to see next. Ultimately, you have to ask yourself one final question. Will NuScale be the company that cleanly powers the 21st century, or are they just a beautifully engineered physics experiment subsidized by retail investors? Stay focused, keep learning, and we'll see you in the next explainer.